Dividend stocks are a popular investment choice for many individuals looking to generate a steady income stream while also participating in the potential growth of the stock market. These types of stocks are particularly attractive to those who seek to balance risk with reward, as they offer the opportunity to earn regular payments in addition to any capital appreciation that might occur as the stock price rises. In this video, we will explore in depth what dividend stocks are, how they work, the different types of dividends, the benefits and risks of investing in dividend stocks, and how they can fit into your overall investment strategy. Dividend stocks represent shares of companies that pay out a portion of their profits to shareholders on a regular basis. These payments, known as dividends, are typically distributed quarterly, but some companies may pay them monthly or annually. Dividends can be paid in cash, additional shares of stock, or other forms of property, depending on the company's policy. The amount of the dividend is determined by the company's board of directors and is usually expressed as a fixed dollar amount per share or as a percentage of the stock's current price, known as the dividend yield. One of the key reasons investors are attracted to dividend stocks is the income they provide. This income can be particularly appealing to retirees or others who rely on their investments to generate cash flow. For example, if you own shares of a company that pays a dividend of $2 per share and you own 1,000 shares, you would receive $2,000 in dividends each year. This income is generally considered more stable than the potential gains from the stock's price appreciation, which can be unpredictable and subject to market volatility. Dividends are typically paid by mature, established companies that have a steady stream of earnings and are in a strong financial position. These companies are often leaders in their industries and have a history of generating consistent profits. Examples of sectors where dividend-paying stocks are common include utilities, consumer staples, and telecommunications. These industries tend to be less cyclical, meaning they are less affected by economic downturns, which allows companies to maintain steady dividend payments even during challenging times. There are different types of dividends that companies may offer. The most common type is the cash dividend, where shareholders receive a payment in cash for each share they own. Another type is the stock dividend, where shareholders receive additional shares of stock instead of cash. This can be advantageous for investors who wish to reinvest their dividends without incurring transaction costs. Some companies may also offer special dividends, which are one-time payments made in addition to the regular dividend. These are usually paid out when a company has an exceptionally strong financial performance or when it has accumulated excess cash. The dividend yield is an important metric for evaluating dividend stocks. It is calculated by dividing the annual dividend payment by the stock's current price. For example, if a stock pays an annual dividend of $3 and its current price is $100, the dividend yield would be 3%. The dividend yield provides a way to compare the income potential of different dividend stocks, but it should not be the only factor considered when evaluating an investment. A high dividend yield may indicate that a stock is undervalued, but it could also be a sign that the company is in financial trouble and may not be able to sustain its dividend payments. Investing in dividend stocks offers several benefits. One of the primary advantages is the potential for a steady income stream. This can be particularly valuable for investors who are in or nearing retirement and need a reliable source of income. Additionally, dividends can provide a cushion during periods of market volatility. When stock prices are falling, the income from dividends can help offset some of the losses, making it easier for investors to stay invested and avoid panic selling. Another benefit of dividend stocks is the potential for compounding returns. When dividends are reinvested, they can be used to purchase additional shares of stock, which in turn generate more dividends. Over time, this compounding effect can lead to significant growth in the value of the investment. This strategy, known as dividend reinvestment, is a common approach among long-term investors who are focused on building wealth over time. Dividend stocks can also be a sign of a company's financial health and stability. Companies that consistently pay dividends are often viewed as being in a strong financial position with the ability to generate steady profits and return value to shareholders. This can make dividend-paying stocks less risky than non-dividend-paying stocks, which may be more dependent on capital appreciation for their returns. However, there are also risks associated with investing in dividend stocks. One of the main risks is the potential for dividend cuts or suspensions. If a company's financial performance deteriorates, it may be forced to reduce or eliminate its dividend payments. This can lead to a decline in the stock's price, as investors who rely on the income from dividends may sell their shares. Additionally, companies in certain industries, such as technology or biotech, may choose not to pay dividends, preferring to reinvest their profits into growth opportunities. This can limit the pool of dividend-paying stocks available to investors. Another risk is that dividend stocks may underperform during periods of strong economic growth. In a bull market, investors may be more focused on growth stocks, which have the potential for significant capital appreciation, rather than on dividend stocks, which offer more modest returns. This can lead to a situation where dividend stocks lag behind the broader market, particularly if interest rates are low and investors are seeking higher yields from other types of investments. When investing in dividend stocks, it's important to consider the company's dividend policy and track record. Companies with a history of consistently paying and increasing dividends are often referred to as dividend aristocrats. These companies have demonstrated their ability to generate profits and return value to shareholders over long periods of time. Investing in dividend aristocrats can be a way to reduce risk and increase the likelihood of receiving steady income from your investments. It's also important to diversify your portfolio of dividend stocks. While dividend-paying stocks can provide stability and income, they are not immune to market downturns or economic challenges. By spreading your investments across different sectors and industries, you can reduce the risk of your portfolio being negatively impacted by a downturn in any one area. For example, if you invest in dividend-paying stocks from the utilities, consumer staples, and healthcare sectors, you'll be less exposed to the risks associated with any single industry. Another consideration when investing in dividend stocks is the tax treatment of dividends. In many countries, dividends are subject to taxation, which can reduce the overall return on your investment. However, some countries offer favorable tax treatment for qualified dividends, which are typically taxed at a lower rate than ordinary income. It's important to understand the tax implications of dividend investing in your country and to consider strategies for minimizing your tax liability, such as holding dividend-paying stocks in tax-advantaged accounts like IRAs or 401(k)s. In addition to individual dividend stocks, investors can also gain exposure to dividends through mutual funds or exchange-traded funds, ETFs, that focus on dividend-paying stocks. These funds pool money from many investors to purchase a diversified portfolio of dividend stocks. This can be a convenient way to gain exposure to a broad range of dividend-paying companies without having to pick individual stocks. Additionally, dividend-focused funds may offer the benefit of professional management, which can help identify high-quality dividend stocks and manage risk. One popular strategy for dividend investors is to focus on high dividend yield stocks. These are stocks that offer a relatively high dividend compared to their price. While high dividend yields can be attractive, it's important to approach these stocks with caution. A high dividend yield may indicate that the stock is undervalued, but it could also be a sign that the company is in financial trouble and may not be able to sustain its dividend payments. It's important to thoroughly research any high dividend yield stock before investing and to consider the company's financial health, dividend history, and future prospects. Another strategy is to focus on dividend growth stocks. These are companies that have a history of consistently increasing their dividend payments over time. Dividend growth stocks can be an attractive option for long-term investors, as they offer the potential for both income and capital appreciation. Additionally, companies that consistently increase their dividends are often in a strong financial position and have a commitment to returning value to shareholders. Investing in dividend growth stocks can be a way to benefit from the compounding effect of reinvested dividends and to build wealth over time. Some investors may also choose to invest in dividend-paying stocks as a way to hedge against inflation. Inflation erodes the purchasing power of money over time, which can reduce the real value of fixed income investments like bonds. Dividend-paying stocks, on the other hand, offer the potential for both income and capital appreciation, which can help offset the effects of inflation. Additionally, companies that are able to raise their prices in response to inflation may be able to pass these higher costs onto consumers, which can help maintain their profitability and support continued dividend payments. It's important to remember that dividend stocks are not a guarantee of income or returns. While many dividend-paying companies have a history of providing steady income, there is always the risk that a company could reduce or eliminate its dividend payments if its financial performance deteriorates. Additionally, dividend stocks are still subject to market risk, meaning that their prices can fluctuate based on changes in the broader economy, interest rates, or investor sentiment. As with any investment, it's important to carefully consider your risk tolerance and investment goals before investing in dividend stocks. For investors who are interested in dividend stocks but prefer a more hands-off approach, there are dividend-focused ETFs and mutual funds available. These funds invest in a diversified portfolio of dividend-paying stocks, which can provide exposure to a wide range of companies and industries. Dividend-focused funds can be a convenient way to gain exposure to dividends without having to pick individual stocks or manage a portfolio. Additionally, these funds often provide professional management, which can help identify high-quality dividend stocks and manage risk. Another consideration for dividend investors is the potential for dividend reinvestment. Many companies offer dividend reinvestment plans, DRIPs, which allow shareholders to automatically reinvest their dividends into additional shares of stock. This can be a convenient way to build wealth over time, as it allows you to take advantage of the compounding effect of reinvested dividends. Additionally, some DRIPs offer shares at a discount to the market price or with reduced transaction costs, which can make reinvesting dividends even more attractive. It's also important to keep an eye on the payout ratio of dividend-paying companies. The payout ratio is the percentage of a company's earnings that are paid out as dividends. A high payout ratio may indicate that the company is returning a large portion of its earnings to shareholders, but it could also be a sign that the dividend is unsustainable if the company's earnings decline. Conversely, a low payout ratio may indicate that the company has room to increase its dividend payments in the future. When evaluating dividend stocks, it's important to consider the payout ratio in the context of the company's overall financial health and growth prospects. Another strategy for dividend investors is to focus on companies with a history of paying dividends through both good and bad economic times. These companies, often referred to as dividend champions or dividend kings, have demonstrated their ability to generate steady profits and return value to shareholders over long periods of time. Investing in these companies can provide a measure of stability and confidence, as they have a track record of weathering economic downturns and continuing to pay dividends even during challenging times. Investing in international dividend stocks can also be an attractive option for investors looking to diversify their portfolios. Many companies outside of the United States pay dividends, and investing in these companies can provide exposure to different markets and economies. However, it's important to be aware of the potential risks associated with international investing, such as currency fluctuations, political instability, and differences in accounting standards. Additionally, dividends from foreign companies may be subject to withholding taxes, which can reduce the overall return on your investment. It's important to carefully research any international dividend stocks you're considering and to consult with a financial advisor if necessary. Dividend stocks can also play a role in a tax-efficient investment strategy. In many countries, dividends are subject to favorable tax treatment, particularly if they are qualified dividends. Qualified dividends are typically taxed at a lower rate than ordinary income, which can make them an attractive option for investors seeking to minimize their tax liability. Additionally, holding dividend-paying stocks in tax-advantaged accounts like IRAs or 401(k)s can further reduce the tax impact of your investment. It's important to understand the tax implications of dividend investing in your country and to consider strategies for minimizing your tax liability. One of the advantages of dividend stocks is their potential to provide a steady income stream even during periods of market volatility. While stock prices can fluctuate based on changes in the broader economy, dividend payments are generally more stable. This can make dividend stocks an attractive option for investors who are looking for a reliable source of income. Additionally, the income from dividends can help offset some of the losses that may occur during a market downturn, making it easier for investors to stay invested and avoid panic selling. For long-term investors, dividend stocks can be a powerful tool for building wealth. The combination of steady income, potential capital appreciation, and the compounding effect of reinvested dividends can lead to significant growth in the value of an investment over time. This is particularly true for dividend growth stocks, which offer the potential for both income and capital appreciation. By focusing on companies that consistently increase their dividends, investors can benefit from the power of compounding and build wealth over the long term. It's also important to consider the role of dividend stocks in your overall investment strategy. While dividend stocks can provide stability and income, they should be just one part of a diversified portfolio. A well-rounded investment strategy should include a mix of asset classes such as stocks, bonds, and real estate to help manage risk and achieve your financial goals. By diversifying your portfolio, you can reduce the impact of any single investment on your overall financial health and increase the likelihood of achieving long-term success. In conclusion, dividend stocks are a popular and powerful investment choice for those looking to generate a steady income stream while also participating in the potential growth of the stock market. These stocks offer a unique combination of income, capital appreciation, and potential tax benefits, making them an attractive option for a wide range of investors. However, like any investment, dividend stocks come with risks, and it's important to carefully consider your investment goals and risk tolerance before investing. Whether you're a retiree looking for income, a long-term investor focused on building wealth, or someone seeking to diversify your portfolio, dividend stocks can play an important role in helping you achieve your financial goals. By understanding how dividend stocks work, evaluating the risks and benefits, and incorporating them into a well-diversified investment strategy, you can make informed decisions that support your financial future.